Why does Tesla command a valuation that simply can't be explained by car sales alone? The answer is straightforward. The car is not the product. It's the platform. In 2020, Tesla's net income was approximately $721 million. Yet in that same year, regulatory credit sales alone generated roughly $1.58 billion in revenue. Vehicle sales margins were not significantly different from Toyota's or Volkswagen's. So why does that matter? This slide tells the whole story. Tesla's consolidated operating margin for 2023 was approximately 9%. Toyota's that same year was roughly 12%. Not exactly extraordinary. Measured purely as an automaker, Tesla is not an exceptionally efficient company. So why does the market trade Tesla at more than 10 times Toyota's valuation? Regulatory credits, software, and energy. Those three revenue engines hold the answer. This is a fact proven by a decade of financial filings. Not speculation. These are numbers recorded in earnings reports. And this is something you can understand. Look at the financial structure and it becomes clear. Follow the business model and it becomes clear. By the end of this, you'll understand exactly what kind of company Tesla really is. Today, let's look at the data. First, regulatory credits. In the United States, automakers that sell above a certain volume are required to hold zero-emission credits proportional to their electric vehicle sales. Under this framework, adopted by California and several other states, companies that cannot generate enough credits on their own must purchase them from other manufacturers on the open market to meet compliance requirements. Similar structures exist across Europe as well. Every vehicle Tesla produces is an electric vehicle. That means credits accumulate automatically and at scale. Tesla sells those credits to manufacturers like Ford, Fiat Chrysler, and Honda companies, still in the early stages of their EV transition. The additional manufacturing cost is negligible. On the books, this registers as high-margin revenue. In 2020, Tesla's regulatory credit revenue totaled approximately $1.58 billion. Net income that same year was roughly $721 million. In other words, without credit revenue, Tesla would almost certainly have posted a net loss that year. These figures come directly from Tesla's Form 10-K. By 2023, credit revenue had grown to approximately $1.79 billion. But net income that year reached roughly $15 billion, bringing credits down to approximately 12% of the total, a dramatic shift in proportion. Tesla's core vehicle business had turned genuinely profitable. Here's a critical caveat. Regulatory credits are not a permanent revenue stream. The more competitors accelerate their EV transition, the more they generate their own credits and demand for Tesla's diminishes. Tesla itself discloses this as a risk factor. This revenue source may contract over time. Revenue built on regulatory advantage shrinks as regulations and competitors evolve. Next, software. Tesla sells full self-driving, or FSD, as an optional add-on. It's currently offered under the name FSD Supervised, meaning driver oversight is still required at this stage. This is not full autonomous driving. That distinction matters, and it's worth understanding precisely. Pricing varies by time period and region. The latest official pricing is listed on Tesla's regional websites. As a reference point, in April 2024, the U.S. outright purchase price was cut to $8,000, with a monthly subscription option at $99, a dramatic reduction. A strategic price adjustment designed to accelerate adoption. Consider the fundamental difference from physical auto parts. Adding one more engine requires steel, a factory, and workers. Adding FSD to one more vehicle requires an internet connection and a software transmission. The marginal cost of each additional unit is small. That said, the system as a whole demands enormous upfront investment. Large-scale compute infrastructure for AI training, engineering, data processing. On a 2024 earnings call, Elon Musk explicitly stated that Tesla would expand its AI infrastructure investment to the scale of billions of dollars. The incremental cost per unit is small, but the total development cost is massive. And here is where Tesla's structural advantage becomes clear. the millions of vehicles already on the road are all potential revenue assets. Even without selling a new car, Tesla can monetize existing customers through OTA updates that add new features. Then in October 2024, Tesla unveiled the Cybercab, a dedicated robotaxi with no steering wheel and no pedals. This isn't just software distribution. It signals a shift toward a fundamentally new business model: autonomous transportation as a service. The third revenue engine, energy. Tesla's energy division is one that most people overlook. Yet in 2023, this segment surpassed $6 billion in revenue. There's an even more telling number: gross margin. In Q4 2023, the energy segment posted a gross margin of approximately 22%. The automotive segment for the same period was roughly 17%. Within Tesla, energy has become the most capital-efficient business. Powerwall is a home battery system. It stores electricity generated by solar panels during the day for use at night or during outages. Pricing varies by region and installation conditions, but in the US, all-in costs frequently run into the tens of thousands of dollars. Megapack is a large-scale battery system designed for utility operators. In South Australia, a major Megapack installation has been deployed to stabilize grid frequency. Similar projects are underway in Texas. Solar Roof integrates photovoltaic material directly into the roofing tiles themselves. Rather than mounting panels on top of an existing roof, it merges architecture and power generation into a single, high-value product. In 2023, Tesla deployed 14.7 gigawatt-hours of battery storage, a 125% increase year-over-year. As intensifying EV competition begins to compress vehicle margins, the energy segment is moving to fill that gap. Now, let's step back and look at the full picture. Tesla's revenue streams number more than 4. There are actually 5: vehicle sales, regulatory credits, FSD software, energy, and services. The services and other segment generated approximately $8.3 billion in revenue in 2023. This includes supercharger usage fees, used vehicle sales, and parts. A figure too significant to ignore. And these streams don't operate in isolation. They reinforce each other. More EV sales generate more regulatory credits. More vehicles on the road accumulate more FSD training data. More data improves FSD accuracy, which drives adoption higher. A broader supercharger network increases the utility of owning a Tesla, which drives more sales. Meanwhile, the energy business independently captures renewable energy markets while reinforcing Tesla's brand credibility. What's the result? The lifetime revenue generated by a single vehicle sale far exceeds its sale price. The car is not a commodity. It's a touchpoint that generates recurring revenue. This is why the market benchmarks Tesla not against Toyota or Volkswagen, but against Apple and Microsoft. You might be thinking, isn't that valuation simply too high? The answer to that question depends entirely on whether the final piece, Cybercab, actually materializes. Here's today's summary. First, regulatory credits underwrote Tesla's early profitability. In 2020, Tesla's regulatory credit revenue reached roughly $1.58 billion, far exceeding that year's net income of approximately $721 million. During a period when vehicle sales alone generated virtually no profit, the compliance costs paid by rival automakers were what made Tesla's business viable. However, as competitors accelerate their EV transition, this revenue stream will likely contract. That's a fact Tesla itself discloses as a risk factor. Second, software and energy became the next pillars. FSD carries a low marginal cost structure, and in 2024, pricing was reduced to accelerate adoption. The energy segment surpassed $6 billion in revenue in 2023, with a gross margin of roughly 22%, outpacing the automotive segment's approximately 17%. Services and other segments have grown to approximately $8.3 billion as well. Tesla's revenue story can no longer be told through vehicle sales alone. Third, Tesla is standing at its next inflection point. In October 2024, the Cybercab, a purpose-built robotaxi with no steering wheel and no pedals, was unveiled. The pivot from selling software to operating autonomous transportation as a service. If this transition succeeds, Tesla's business model will undergo another fundamental transformation. Now, consider this. If you were running a rival automaker, how would you build a strategy against a competitor with 5 distinct revenue streams? And one more. In a world where cybercab is mainstream, where does Tesla's revenue actually come from? Let me know your thoughts in the comments. Thanks for watching all the way through. Why do companies like Tesla carry the structures they do? This channel dissects that question through the lens of geopolitics, economics, and business models, using data. If you want to understand how the world works, not through emotion, but through facts, not through surface impressions, but through underlying mechanisms, this is the channel for you. Subscribe and turn on notifications so you don't miss the next analysis. See you next time.